We're at 7:30.
Okay, you want me to run the committee meeting remotely? Okay.
As requested by the chair, yes, please.
Okay, well, welcome everyone to the audit committee meeting. We want to do the roll call?
Yeah, you know what, I will do a roll call since I'm not sure who all we have.
So trustee Fair, Singer, and Fall are attending remotely.
Okay, all right, so we'll note that all members are present. Thank you. All right, we've confirmed that all members are present. Trustee Singer.
Okay, Tim, I'll tell you, there is quite a lag time between the telephonic audio and the Zoom meeting thing.
All right,
So I'm going to just go on. I'm just going to go on the telephonic. There's about a 15-second lag. So anyway, okay. So we've done the roll call. Approval of minutes. Can I have a motion to approve the minutes?
So move. Second.
All in second?
Second.
All in favor? Say aye. Okay, the minutes have been approved. Comments of the chair, there are none. Agenda item 4, internal audit report presentation, review of project accounting.
Okay, that'll be Todd Loretta.
Yeah.
We do have Brown Smith Wallace on Teams,
Yeah,
but I
they're
think.
listening, Brett Simmons and Ron Stein.
Okay, so if we need them, they're there, but I think Todd's going to handle.
Have to be loud.
All right.
Use the microphone, yeah, thanks.
Can you hear me, guys? Yes, let's try it here. How's that? Is that a little better? So if you would, go ahead and grab this presentation, the PowerPoint. You guys remotely should have a PowerPoint document. It's called Review of Project Accounting. If you open to page 2, we're going to start with a little overview. So much of this area centers around the CRP, which stands for the Capital Improvement and Replacement Program. Over the past 5 years, the district has budgeted about $1.75 billion in project costs to this program. And you can see the numbers, the dollar amounts, and the number of projects on that page. So obviously, this is a big area for expenditures. Expenditures in this area are significant. I'm probably not telling you anything you don't already know, but I think it's good to get the numbers in front of you. If you would have moved to page 3. 3, yes. You can see on that page, this is just a map of all the projects that are in process for the fiscal year and next fiscal year. Again, this just shows you the magnitude of this whole program. If you move on to page 4, one of the questions I wanted to answer is, what are the factors that are driving this program? There's probably 3 factors. The main factor is consent decree. That was issued in 2012, and the focus of that program, or that decree, is elimination of sewer overflows. And the district really approaching this effort in taking 2 approaches. The first approach is to increase the system capacity. The second being reduce the amount of water is actually getting into the system. Now, each one of those is going to trigger a number of projects, and they certainly do. Second item is in ongoing recent regulatory requirements. Those also trigger more projects. And then as the district identifies infrastructure deficiencies, those also trigger more projects. So all those are going to trigger projects. The consent decree obviously being the biggest one. You move on to page 5. Now, as far as our scope, we focused on processes performed by engineering, finance, and treasury. The bulk of the procedures are performed probably by engineering and finance. Treasury acts in more of an oversight role in this area. For contracts and activities and transactions, we focused on projects that were finalized in FY 18 and 19. The last time we looked at this area was back in about 5 years ago. It's the last time we looked at it, which leads me to my next slide, page 6. So this is a slide that I have showed to you before. It explains the focus of external audit versus internal audit. And this is one of those areas, this audit was one of those areas that we're kind of in that middle ground, where we're almost bumping up against what the financial auditor does. They do the annual audit, but at the same time, we're getting down into more detail into the processes in the bottom, and we're getting into the weeds. So we try to strike a balance there, because we know they're looking at it every year, but we want to get in more detail every 3, 4, 5 years. And that's why the timing is what it is. If you have any questions, please let me know. Page 7, a little overview about the initial project setup. Now look in the top corner of that flow chart. Engineering develops and identifies a list of projects. And basically that all starts with those cost drivers that I just talked about, the consent decree and so forth. That is where they're developing the list from. And they're doing this in conjunction with the Treasury Department, because the Treasury has to schedule out the funding. We have to have the money to pay for everything. Now, as they develop their list, they present this, the ordinances to the board. The board approves the appropriation in the contract. Then it moves over to Treasury. Treasury sets up the overall funding and award in the system. And then after that, it moves over to engineering, who also.
I think that's feedback.
Is that just feedback? Okay. Moves over to engineering, and they actually set up the project budget in the system. Then it finally moves to finance, who actually approves the budget in the system. So as you can see, there are a lot of checks and balances throughout this setup process. And there's a lot of money we're talking about. So it is good to have all these steps and checks and balances. So we move down to the second half of the page. This is where I want to talk about at a high level, the process for actually paying the contractors. Now, this all starts out in the field at the project level, at the actual project. We have inspectors on every project. And basically, they're out there monitoring the progress and documenting their progress in their notes. And basically, they take notes and actually map it out and calculate dollar amounts in their notes. And from those notes, they develop a pay application. And once that pay application is developed, it moves over to the contractor for review and approval. They don't always agree. Sometimes there's some back and forth. But once they do agree, it's sent over to the program manager and director, and they finalize it and they sign off on it and approve it. Rich actually signs off on every pay application. So then it moves down to finance. AP actually processes the payment, and then the finance capital team does some general ledger work, which I'm not going to get into. It's too complicated for this. Any questions on that?
Yeah, this is Jim. That first step on the left by your sheets, is that actually a paper record, or is that just a reference to a type of electronic record?
It is a paper record. There has some. We're going to talk about that in one of our recommendations later. I guess one thing I didn't mention, you see the 2 red arrows, though? Red arrows in that section of the flow chart. We had some recommendations in those errors, and we'll talk about that later.
Okay.
Did I answer your question, I hope?
Yeah.
Okay. So we move over to page 8 as far as our objectives for this engagement. One of the main objectives was to make sure the activity is being captured accurately and completely throughout the various stages of the process. Again, this all starts with the field notes out in the field on the left-hand side there. So we want to make sure that documentation was tying to the manual pay application, which should tie to the system pay application and should tie to the actual payment. Move down to the middle box. You can see you got the payments plus any overhead that gets added and design costs. You bring that over to the GL, everything should be tying. So we want to make sure that was happening. Obviously within budget amounts and appropriation amounts. So at the bottom, to summarize, we want to make sure the engineering project files equal the finance project files, which also equals the general ledger. Everything should be tying throughout the process, and that's one of the main objectives we had throughout this audit. So with that, I'm going to move on to page 9. More about the objectives. Excuse me, want to make sure, again, the costs were recorded accurately, completely, and timely. But at the same time, we want to make sure the costs are authorized and supported. That's very important. Also want to make sure there's adequate separation of duties, which I kind of showed you in that slide about the project setup. Want to make sure the budget and assets are adequately safeguarded. Want to make sure we're adhering to the budget. If you move down to the last bullet there, another big item was to make sure the communication and coordination procedures utilized between the various departments are designed properly. There's a lot of steps between departments that go back and forth. We want to make sure there's no gaps or holes within the inter-department processes. Nothing falls through the cracks, that type of thing. Page 10. So how do we approach this audit as far as methodology? We did, as we always do, a lot of walkthroughs. Probably more walkthroughs on this one than we normally do because there are just so many people involved. We probably talked to 15 different people numerous times. So there's just a lot of people involved in this process. So we wanted to, get a handle on the overall flow of information and data between the departments. How each project is developed and approved, how the funding and the budget is established, including the setup and the system. Page 11, as far as, another big area was the accumulation and recording of costs by engineering personnel, very key part of the process. The procedures used by the inspectors out in the field to capture the progress and document that progress. We actually spent a day out there, a couple of days out there with the inspectors and observed how this was done at the actual projects. The creation and completion of the pay application documentation, and then the review and approval of those pay applications. We went through all that pretty thoroughly. Then we also walked through the actual process of the payment by the AP personnel. And then finally, we discussed the overall capturing of the project costs on the general ledger with the capital team. Again, that's some of the area that the external audit will hit also this year. But we looked at it as well. So, any questions? So, page 12. In addition,
Hold on a second.
Yep.
And maybe this comes up, I was a little bit ahead, and maybe this comes up. Did your audit get into, one, if we have enough inspectors, and two, if our inspectors are adequately trained on the different things that they're inspecting on? I know they wear a couple of different hats.
There was a question.
The question was about inspectors and if the audit touched on any of the inspection tasks. This was all accounting.
Are we properly
right?
staffed?
Oh.
And are they properly trained?
We didn't touch on the training.
Well, okay, into the microphone.
I'm sorry, we didn't touch on the training, I'm sorry. We did a walkthrough of all the procedures they handle and kind of a day in the life of an inspector, so to speak. And we talked to the supervisors as well and their managers. And we reviewed all the documentation that they put together in the files.
Okay, good. So my question is beyond the scope of this. That's fine.
That's correct, Jim.
Okay, thank you. Not a problem.
This is Jim Singer. It was almost impossible for me to hear what Jim was asking. I don't know if it's a problem with the system or if Jim wasn't speaking in the microphone. I don't know. Anyway, if it might help if when responding to a question, you could at least try to summarize the question because I couldn't hear what Jim was asking.
Yeah, Jim, this is Brian Holscher. We'll try and do that next time. The question was whether or not we have proper amount of staffing and whether or not the inspectors were properly trained. And Todd responded that was beyond the scope of this audit. And Jim Fall said, okay, I understand. And we'll make sure we're very careful about repeating the questions.
Thank you.
Okay. Okay, so we're on page 12 right now of the presentation. So in addition to the walkthroughs, we did some testing of the actual project documentation. So we made a selection of 30 different projects review and testing. The three sources that we looked at were the engineering project file documentation, the finance project file documentation, and also the general ledger. And we were testing and reviewing for, completeness of the documentation, make sure everything was there, the accuracy of the documentation, consistency between the three sources. Again, everything should tie. Cost compliance with the budget and the ordinance amounts, and then obviously appropriate approvals throughout this entire process. We're hoping to see a lot of review and approvals, which we did see. So I'm going to move on to page 13 with that. As far as our overall results, we had a satisfactory opinion. It was a clean opinion, so this went pretty well. No significant deficiencies were noted. We did identify 2 opportunities for improvement. The topics were approvals of the initial pay applications, and the second topic was the project files for engineering, where they were missing some documentation in those files. I guess one thing I want to say, both those items have already been addressed by management. They were very proactive in this. They've already established some brand new procedures for each one of these items, so we've already seen new documentation and proof of the new procedures in place. So kudos to them for that. If we go on to page 14, I'm going to talk about, this is the slide, this is the flow chart I showed you earlier. So getting back to those pay applications, our first opportunity for improvement was around the initial pay applications. What we were seeing there was no documented approval by the program manager before that application was leaving our building and going over to the contractor. And what we really wanted to see was, some kind of documented approval before that document leaves our building and goes to the contractor. And that's what we're recommending. And they've already added a new procedure for that. There's a new stamp they put on there. It requires the program manager to sign off. It can't leave without that signature right now. So they've addressed that item. Now, the second item has to do with the field notes. I think you asked about that, Mr. Singer. So they do document everything. And if you want to move to page 16, you can see we're missing, the first item, we're missing portions of the daily field summaries for 4 of the projects. If you take a peek at page 17, there's an example of what a daily field summary looks like. And this is something they fill out every time they go out to a project. It gives it, tells the project name, project number, what the weather's like, is it raining, is it sunny, what kind of work is being done, which contractors are out there, which subcontractors are out there. It really kind of gives an overview of everything you're seeing. So we were missing a few of those in 4 of the projects. Yes, sir.
Todd, this is Jim Singer. Really, the original question I asked, I think, comes back to this, and I don't know if this was within the scope of your audit, but I mean, isn't it? It just kind of surprises me that in this, in 2020, that you still have these paper records. I mean, why hasn't this been? Why are you not maintaining electronic records?
Jim, this is Rich. We have transitioned to electronic records. It's been probably over the last year or so, year to 2 years. Understand getting people trained on utilization of laptops to do this, things like that, and making sure they got the proper equipment. We've been through a couple different types of equipment that's going out in the field. We had tablets and we've gone with laptops, just trying to be the most productive as we can. But we have moved to electronic. So right now, I would say, and I'll peek to Alan right now, but I think pretty much everything we're doing out there is electronic now. He's nodding his head yes.
Okay, so this example is kind of an out-of-date form?
Yeah, again, the transition's been over the last few years to fully electronic.
Well, I think the form is good, but the form's in electronic form. They're the same form, but it's on a tablet now.
That is correct.
Before it was actually handwritten, but they're using the same form. So, and that's part of their steps into alleviate this problem. They're following a lot of these documents electronically, and I think that's a more secure way to do it and more of an organized way to do it. Because some of the projects we were going back to probably 17 and 18. So don't make too much of the reference to binder sheets. That could be a reference to an electronic form as well. Yes. So
Okay.
we were missing a
Okay,
few of
thanks.
those for 2 of their projects. And again, it was more, we think it was more of a file maintenance issue as it was, as opposed to being a completion issue. Things got pulled out of the actually physical file. If you look at page 18, there's an example of a binder sheet, and that's where they put their calculations. So again, as Rich mentioned, a lot of this is electronic now, but basically it's the same format, it's just electronic on a tablet. And they have taken steps to address that issue and make sure it's either filed electronically or physically in the file. But I think more of it's now electronic. Does that answer your question, I hope?
Yeah, thank you.
Okay. And I think that's all we have, unless anybody else has any more questions.
Does any of the members of the committee have additional questions for Todd?
No.
Okay, well, our next meeting is scheduled for May 5, tentatively at least, and I'd be happy to entertain a motion to adjourn.
So move.
Second, all in favor, say aye. The meeting is adjourned. Thank you.
Thanks, everybody.
We're going to go ahead and start. We'll switch over documents or do we have anything else paper-wise that we need to distribute, Rich?
No, everything is
Everything we have, okay.
electronic on the program.
So if somebody just say they're ready to go, if we get 5 yeses, then we'll pass it over to Mr. Fall.
So Jim sent to me several documents here, several emails. I'm trying to figure out which one is next.
So we're
Are we doing finance next?
program management, Jim.
Okay, let me see if I can pull that up.
And this will be Jim Fall doing this one.
Okay, hold on.
Yeah.
Do I have 5, Brian?
You can if you can.
What do you say?
You have 5.
We're still waiting on Jim Singer, Jim.
Okay, I'm just trying to find the email with the documents. Hold on. Oh, got them. Okay, I'm ready to go.
You're down there.
Just a minute, Jim Fall. Just a minute, please.
You're
Colonel Wilson, you got your spot for the program management committee.
Yes, I'm sorry.
Okay.
Sorry.
Just a minute, Trustee Fall. We're getting the technology right, and we'll be ready to go.
I'm under no pressure. That's fine. Let me know.
So this is your mouse. And that's your button on the microphone.
Thank you.
Are they gonna show up? Because I didn't.
Modern technology.
So
Crazy, isn't it?
will not be up on Teams. Now they have their copies we sent.
They've already got it.
No, Jim do that.
Yes, we're
No program manager.
Program manager.
PM to start. We are setting up between meetings right now. Literally, as soon as they get done figuring out you guys want to wipe things down?
What do they want to do?
Nobody really.
Nobody moves.
We've got him coming through the speakers here. Is Amy the same way now?
Yes, I'm on.
Okay, so you're all coming through loud and clear. So good. They already have it, don't they? The presentation, the board. That's what I'm asking is the board. Peanut Gallery is Pleasant.
Yeah.
Who's the peanut? Huh? God bless him. So these are not presentations. That's what. Are we ready?
Yes.
Okay. Trustee Fall, we're ready to go.
Wonderful. With that, I'll open the 204th meeting of the Program Management Committee for the Metropolitan St. Louis Sewer District. Please let the record note those trustees, members of the staff, and members of the public in attendance. Entertain a motion for the approval of the minutes of the March 3rd meeting.
So move.
Having moved and second, the minutes are adopted. Third agenda item is that of the engineering department, where the engineering department will present 9 items from the CSO volume reduction green infrastructure in St. Paul's Missionary Baptist Church, all the way to the Stanwood and Bellwood Drive storm sewer and bank stabilization easements. Thank you.
All right, welcome this morning. As Jim indicated, just so you're following along, the first 3 items are CSO volume reduction green infrastructure grant projects. So you'll have the actual board agenda sheet followed. Each one of these will be followed by a document or attachment that shows the location of where it's at and what they're proposing to construct. So the first one is the CSO volume green up infrastructure located at the Greater St. Paul Missionary Baptist Church. That's in the city of St. Louis. This ordinance will authorize the district to enter into agreement with Greater St. Paul Missionary Baptist Church, provide financial assistance to the Green Infrastructure Grant Program for the construction of green infrastructure. The purpose of the project is to reduce combined sewer overflows to the Mississippi River per our long-term control plan and the consent decree. This project will reduce runoff volume with the installation of 1 bioretention basin. The cost of the project is estimated at $39,800, and the Greater St. Paul Church is requesting the full amount, $39,800 reimbursement for the green infrastructure. Now, if you go to the attachment, this project is located in North St. Louis City, near West Florissant and Riverview, actually along Hanley and Oriole. The church is building a new parking lot, and they're installing a bioretention basin that will capture flows before it reaches the combined sewer system. So that's the dark green area shown on the map. And I'll take questions. No questions, we'll move on to the second item.
Thank you.
The second item is the CSO volume green infrastructure at Rankin Technical College. This ordinance authorized the district to enter into agreement with Rankin Technical College to provide financial assistance through the Green Infrastructure Grant Program. The purpose of this project is, again, to reduce overflows, combined sewer overflows to the Mississippi River per the consent decree. The project will reduce runoff with the installation of 2 permeable pavement areas and multiple amendment soil areas. The total cost of the project is estimated at $42,000, and Rankin is requesting the full amount, $42,000 reimbursement for this green infrastructure. So if you look at the large attachment showing where this is located, you'll see a drawing that shows two separate parcels where there's going to be parking areas along, at each one of these, along with capture amended soils where they churn up the soil to allow it to accept more water. And again, this will prevent water from going out and entering the combined sewer system. This is up in North City as well, in the Ville neighborhood.
Rich, this is Jim Singer. I'm sorry if I didn't follow the initial instructions. I'm having problems with correlating your comments with the agenda items. I mean, the first one I had on this long list was 3576. Where are you? Are you? I guess you're not all.
I'm looking for 3576.
That was the first one.
So you followed me on the Baptist Church parking lot?
I was just listening and trying to figure out where you were, and realized I was completely lost. I've got the Glen Drive. The second one is
We've done St. Paul. We've done Rankin. We're moving on from there.
I'm not sure he has the right document.
Yeah.
He mentioned Glen Drive. He may be on a.
Yeah, are you looking at the March 31st agenda, Mr. Singer?
No, I was looking at the engineering. Okay, so you're working off of this list of documents. This is the March. Well, okay. Well, I apologize for that.
He was on
I guess I was.
last month.
I'm looking. I'm not. Well, no wonder I can't find. I'm on the wrong agenda.
Yeah, Jim, they're all dated April 9th.
Yeah, the minute sheets, Jim, all are dated April 9th because that's the date of the full board meeting that we're going through. So we're discussing or finishing up discussing Rankin now. Is that correct? Is that correct?
Yes.
Yes.
Did somebody resend me the program management agenda materials?
I'll send it to him right now.
Okay, thank you.
Thank you.
Yeah, that would have come
okay.
yesterday from Sharon.
Trustee Singer, you should have gotten it from Sharon yesterday. If Jim Fall's sending it to you, if you don't mind, let us know when you have it and you're ready to continue.
Okay, I apologize for trying to maneuver with these electronic records.
Okay, Mr. Singer, I just forwarded it to you. Okay. So can we continue on with St. Mary's then?
Yes.
Thank you.
Third item is the CSO volume reduction, SSM St. Mary's Hospital South parking lot. This ordinance authorizes the district to enter an agreement with SSM Healthcare St. Louis to provide financial assistance to the Green Infrastructure Grant. The purpose of this project is to reduce combined sewer overflows into River to Pear per the long-term control plan and the consent decree. This project will reduce runoff with the installation of 5 bioretention basins. The total cost of the project is at $711,600, and SSM is requesting the full amount of $711,600 reimbursement for the cost of this green infrastructure. And if you go to the backup documentation, Up in the right-hand corner, it'll say SSM St. Mary's Hospital South parking lot. And in the middle, you'll see, in the dark green, you'll see 5 bioretention basins situated primarily around the perimeter of the hospital where they're redoing their parking lots, and they're installing detention basins to capture that flow. So there's a significant amount of flow being captured from the parking lots and percolated into the ground before it goes into the combined sewer system. And St. Mary's
Yeah, I know
Hospital is located.
that the rain will run pretty fast down the street there in front of the Cheshire and that, so that'll be good.
Jim, did you have a question?
No.
Make sure you say which Jim, Rich. If you
Oh, that's right. Mr. Singer, did you have a question? I thought I heard something.
I'm following you along. No, everything's copacetic.
All right, thank you. All right, moving on to the next item. The next item is the Infrastructure Repair Rehabilitation Contract B. This action appropriates funds and authorizes staff to enter into a construction contract. The work to be done consists of the rehabilitation of approximately 42,000 feet of sanitary sewers, 6-inch to 60-inch in diameter using the cured and placed pipe method. The purpose of this project is to reduce infiltration and to rehabilitate older, damaged, and deteriorated sanitary sewers throughout the district boundaries. Sewers identified for rehabilitation are usually identified through our annual CMOM inspection program, which is required by the consent decree, as well as this rehabilitation is also required by the consent decree. The district received 2 bids for this work. The low bid was from In Situ Form Technologies USA. The bid was below the designer's estimate, and our appropriation of $2.05 million is below our budget of $2.5 million for the project. In Situ Farm has committed to 20.51% WBE participation on this particular project because we're funding our rehabilitation work through state revolving fund loan. The requirements for minority and women participation is 10% for minority and 10% for women, and In Situ Farm has met those goals for the project. Moving on to the next item. It is a Mississippi Floodwall ORS pump station rehabilitation. This is phase 2 of this program. This action appropriates funds and authorizes staff to enter into a design build contract. The work to be done consists of the design and construction of 12 large gates, the rehabilitation of 4 large gates, and the replacement of 14 actuators at the Baden Pump Station and emergency closure structure along the Mississippi River, the design and construction of 1 large gate, the design and construction of 2 bar screens, and the rehabilitation of 3 large gates at the Riverview Pumping Station. And then finally, 1 large gate and the replacement of 2 actuators and appurtenances in the Riverview collection system. The purpose of this project is to restore function, improve reliability, increase the operational efficiency of the essential components of the St. Louis floodwall protection system. As you recall, the district is planned over a number of years to repair, replace, rehabilitate the different gates. We have approximately 23 gates along the Mississippi, or 23 structures along the Mississippi that provide flood protection. We're systematically going through those and doing projects on those. This is the second of the projects, and we are approaching these projects through design build selection process. On this particular project, the district received 2 proposals for this work. The selected proposer is KCI Construction. KCI Construction not only had the highest rated proposal, which is rated on the staffing, how they're proposing to do the work, and several other items. They also had the lowest financial proposal of $9,495,000 on the project. The second proposer was Goodwin Brothers Construction. Those are the appropriation, total appropriation for the project is going to be $10 million. Our designer's estimate was $12 million, and the $10 million is what we had proposed for a budget for the project, so it met the budget amount. The MBE participation, since this is a design build, on the construction side, we required 17% goal for African American. The proposer, KCI, met that with a 20.06% participation. There is no goal for the engineering side of the project, and they are proposing 10% participation from 2 different firms for the design of the project. No questions, we'll move on to the next item. It is a Riverside and Yarnell Relief Replacement Project. This action appropriates additional funds on an ongoing construction project being constructed by Undersall Contracting. This is the second of 3 planned appropriations on the project. The work to be done consists of construction of approximately 5,600 lineal feet of sanitary sewers 12 to 42 inch in diameter, and the rehabilitation of 4 manholes and making 5-point repairs on the system. Again, the purpose of this project is to remove and replace an existing failing sanitary sewer system. Again, this is the second of 3 appropriations. The total appropriation is $3,337,000. There's an additional planned appropriation in fiscal year 21, just over $1 million, which will bring the total appropriation on this project to $7.7 million on the project. The next item is the Kenwood June Bank Stabilization Project. This action appropriates funds and authorizes staff to enter into a construction contract. The work to be done consists of the construction of approximately 1,300 feet of modular block wall, rock lining, and approximately 105 feet of storm sewer 42 inch in diameter, and 165 feet of landslide repair and appurtenances. The purpose of this project is to alleviate erosion threatening residential properties along Kenwood Drive and June Drive, located in the city of Northwoods. The district received 3 bids on this project. The low bid was from JTL Landscaping, LLC. The bid was below our design estimate, but with the extensive utility relocation, there's a utility relocation of $750,000. Our appropriation of $1.825 million is over our budget amount of $1.643 million, which is in the budget. I do want to point out that JTL Landscaping, this is their first project. They have done work on through the small sewer program, but if you look at the bottom of the board intro, it kind of gives some information. They're a landscape company that specializes in erosion, demolition, boulder walls, and creek banks. They do a lot of this on the private side and has a bonding capacity of $6 million. They're located in Florissant, Missouri, and they've been in business since 2004. They'll be required to complete this project in its entirety before they'll be allowed to bid on another one. They've committed to 18.4% MBE participation, which meets the 17% goal in the project. The next item is the Brunston Drive Bank Stabilization Project. This appropriates funds and authorizes staff to enter into a construction contract. The work to be done consists of the construction of approximately 13 feet of storm sewers, 60 inch in diameter, 71 feet of stone wall, and approximately 215 feet of channel stabilization. The purpose of the project is to alleviate moderate risk of structural erosion to the rear properties on Brunston Drive in unincorporated St. Louis County. The district received 3 bids on this project. The low bid was from 2 Alpha Contracting. The bid was below our designer's estimate, and the appropriation of $280,000 is above our budget. There's, again, on this one, there's some $50,000 of utility relocation. In addition, we added an additional stormwater outfall pipe to this project. So we expanded the scope a little bit to include a failing stormwater outfall pipe. Just like the last one, this is a newer contract and district work. The 2 Alpha Contract is a company that offers biological construction service, landscape solutions such as erosion control and environmental creation. They have a bonding capacity of 1.2 million. 2 Alpha is located in Wright City, Missouri, and has been in business since 2009. They have done work on our small sewer program. This is their first one outside of that. If you recall, we've had quite a few of the bank stabilization projects going on throughout the district. And even as early as a couple of months ago, we had a single bid on a project. So I think the industry is starting to see that we have this type of work, and we're starting to draw in some new contractors, which is good for us through our bidding process. All right, our last item is the Stanwood and Bellwood Drive storm sewer and bank stabilization. This authorizes staff to proceed with further condemnation efforts, including the filing of all necessary court pleadings and documents for the acquisition of permanent easements and temporary construction easements on 4 parcels of ground in the city of Normandy. The easements and temporary construction license are needed to construct this project, which consists of the construction of approximately 250 lineal feet of natural bank stabilization, 200 feet of storm sewers 12 to 30 inch and appurtenances. The purpose of this project is to repair a retaining wall failure that threatens 2 storm sewer outfalls and to alleviate street flooding. Currently, the district's been unable to negotiate a settlement with the owners. There were originally 9 easements planned for the project. We've required 4 have been acquired. There's 1 remaining with the county, which we're real close to having signed, which leaves 4. We continue to negotiate with the property owners, but just haven't, in order to keep the project on schedule, we're proceeding with condemnation. Along with this, you should have a map that shows the location of the easements. If you look on the map, there's a large linear easement that is one of the easements through the Lutheran North High School. That is really our main access to get to the project because it's real tight between the houses. So there are actually 2 easements with Lutheran High School. We're working with them to try to find a least disruptive way to get to our project site. So that's kind of where the holdup's been, is trying to decide how we can get into that project. We crossed just a small corner of a apartment complex there in the middle. That's the 3rd easement. And then if you look up to the far right, there's an existing property where we're planning to access this channel. And the big part is getting this channel that's located kind of up against Interstate 70. You'll see that in the lower left corner. But as you can see, the temporary license we're using for that Lot 28 easement from OE Rentals, we're pretty much using their whole yard. So, that trying to work with that property owner to make sure that they're comfortable with the easement. So we've reached a roadblock on that particular easement.
Hi, thank you for that presentation. Whoever is manipulating the pages on the teams, I appreciate that. That was very helpful. Are there any other new business before this body? Hearing none, the next meeting is scheduled for Tuesday, May 5th, 2020, and we are adjourned. Thank you.
Thank you. Thank you, Rich.
Trustee Singer, we do have a few things we're handing out, so as soon as we're ready to go, you will be the chair. You are the chair of the Finance Committee for this morning.
Okay, well, I'm trying to find the agenda materials. But
The materials for this meeting are not going to be on Teams, but we do have copies for people that are in attendance, and the trustees should have all received an email with all the materials yesterday. So I just want to make sure that you have those.
Yes, I have it, Tim. Thank you.
Thank you. Okay, do we have, I'm sorry, Jim, I just want to check real fast to make sure we have Shane and Peter from Aon on.
Yes, Peter's on the line.
Okay, great.
Yeah,
All right.
change it.
Trustee Singer, I think you can go ahead and get started.
okay. Hold on a second. Okay, well, welcome everyone to the 253rd meeting of the Finance Committee of MSD. The roll call we can skip. We've done already. Agenda item number 2, approval of minutes from the March 3rd meeting. Can I have a motion to approve the minutes?
So moved.
Second, all in favor? Minutes approved. Agenda item number 3, Q4 2019 pension update, which I assume is very out of date. But we'll proceed.
It is very out of date. So this is our quarterly pension update. The original purpose of this meeting was to talk about performance through December 31st, 2019. Shane and Peter from Aon will touch on that, but I'm sure they'll talk about the market volatility since, give you an update on where the plan is at a little more recent date, and talk about kind of the impacts of some of the volatility on some of the plans that we've made recently. So, Shane, you want to take it away?
Sure, yeah. I'll maybe just a quick introduction. Yeah. So Shane Schurter, and then we have Peter Lennox on the line as well. I think Peter's actually going to do the initial performance review, and I'll probably jump in with some other updates. So maybe with that, Peter, if you want to get started.
Sure. Thanks, Shane. Good morning, everyone. So the document we're looking at has the title of the Metropolitan St. Louis Sewer District Employees Pension Plan, fourth quarter 2019. As you mentioned, fourth quarter numbers are pretty, seem to be a long time ago these days. So we will be providing some updated February numbers and updated March estimates as well. Flipping maybe to page 7, so what we're showing here is a quick summary of kind of our updated views on the markets, just kind of based on what we've seen happening over the past 2 months or so. It's too early for us to tell whether or not, what has sold off in particular stocks, and we've seen credit sell off pretty significantly with spreads widening. Whether or not we're wholesale buyers of risk yet, by that I mean moving assets more up back towards more towards equity and credit securities, generally sourcing from your more risk-averse fixed income holdings as well. However, we are seeing markets trend that way, and we've seen lately here a bit of a pullback or a bit of a bounce back in markets. Last week was a positive week, pretty strongly positive week in markets, and yesterday was positive as well. Today, kind of opening a bit of a muted day. However, volatility overall is really the main theme here. We've seen volatility continue. It's come down a little bit over the past couple of trading days. However, volatility remains a pretty significant factor within markets. So what we're really watching here is when do we think it is an appropriate time to move more towards equities? If investors are taking a brunt of the sell-off via their equities, we want you all to be able to take participate in the bounce back in equity markets as well. So still determining kind of when is the best time to move back to equities. We are, as best practice, making sure you all continue to be invested within your policy allocation, so making sure you all don't fall outside of the allowable ranges as dictated by the investment policy of your investment. So we work with Tim and John on a periodic basis just to check in and make sure nothing is out of line there, and we've been doing that throughout this market environment, and we will continue to do so. Slides 8 and 9, I'm sure you're all pretty familiar with these types of graphics these days. I think we've all been seeing a lot of exponential charts lately here on slide 9, so maybe I'll skip ahead to slides 10 and 11. What we're showing here is just a market reaction that we've seen on a year-to-date basis. That chart on the top left here, you can see the equity market year-to-date returns, significant sell-off in equities, down 19%, U.S. and global equities on a year-to-date basis. The VIX on the top right is a measure of volatility within the markets, and the higher the VIX, the higher the volatility. You can see there on the right, the VIX has shot up over the past couple of weeks, and it's remained high. It's gotten up almost to 90, which is extraordinarily high and higher than really what we saw during the global financial crisis. Volatility remains very elevated during this market environment. And then on the bottom left, I think it's an interesting chart. You can see U.S. yields come down significantly. So as the risk has increased, volatility has increased, market participants have fled to U.S. Treasuries, and you all do hold plenty of U.S. Treasuries within your fixed income portfolio, particularly within Income Research and Management and Prudential. On slide 11, just one chart to note here would be credit spreads. As I mentioned, we've seen credit spreads really expand over the past couple of weeks. On the chart on the top left, you can see credit spreads. So when I talk about credit spreads, this is the amount of additional yield an investor would receive for holding a corporate bond versus a Treasury counterpart or a Treasury equivalent. So as those spreads widen, the risk of holding those corporate issuances over Treasuries increases. And we actually think that these credit spreads have increased or getting towards, well, they are in cheap territory now. We think it's one of those areas where we look to see opportunities within the markets possibly going forward. Then on slide 12, this chart's really just summarizing why have we seen so much volatility, and I think the box on the top right is really telling. The economic costs are really racking up. I mean, it's large swaths of not only the U.S. but the global economy has essentially been shut down. Travel restrictions, on air travel, plenty of people working in bars and the restaurant industry being laid off, and a number of examples to cite. So the economic costs are really adding up and changing on a day-to-day basis. And as we continue to see different stimulus packages, particularly fiduciary packages coming out of Congress, we start to get a little bit more clarity on what the road looks like ahead, but there is still a significant amount to go and a significant amount to kind of better understanding what the market environment is going to look like going forward and how significant the impact on the economy has. I just saw a number recently, Goldman Sachs, indicating that they expect about 35% loss in GDP over the quarter and 15% unemployment. These numbers change quite significantly. However, those are large numbers and certainly something to continue to watch and continue to hopefully find a bottom and clarity as to what the market environment is going to look like going forward. Then slide 13 is just a look at the change in market valuations. For the blue dots there are as of December 31, 2019. Maybe kind of consider that it's a little bit early, but at the top of the market. And then in the orange charts, that's market valuations through essentially the end of last week. So you've seen valuations become much more reasonable, not necessarily cheap in all cases. However, we are seeing some areas where it does look significantly cheap. On the bottom there, you can see U.S. credit spreads, in particular, and high yield spreads are starting to look more and more attractive, whereas on the far right, more of those risk-adverse assets, such as U.S. Treasuries, are looking pretty expensive. So that said, on slide 16, we can get into an update on how the pension has performed. What we're looking at here are numbers through the end of February 2020. As you all know, this plan is closed, and as a closed plan with a pretty strong funding status, you do all have a more defensive posturing than your peers, and rightfully so. You don't need to take on as much risk in order to meet your future liabilities, and that more defensive posturing has been beneficial compared to peers on a year-to-date basis. Year-to-date, the total plan, again, these numbers are through February, and I'll provide an update through March on the next page. Down 4.1% versus a policy benchmark return of down 3.9%. You can see equities really leading the way down. U.S. equities, large cap down about 8.1, small cap 9.3, and international equities down 9%. Then flipping to page 17, within total fixed income, the top two funds are really the main risk-adverse funds. So about 28%, 30% of your overall plan probably now is very risk-adverse investment grade, U.S. corporate investment grade, or government issuances within the fixed income market. And that's held up quite well so far year to date. You can see Income Research up 2.8%, and Prudential Core Plus up 3.8%. Brandywine, I would note that's a much more aggressive type fixed income fund. We wouldn't consider it a risk-reducing type fund, but more an alternative diversifier away from equity that does where you all would expect to be compensated for the risk you take on. And in fact, in calendar year 2019, you all did get very strong returns from Brandywine, up 9.3%. And just kind of as an overall reminder, 2019, the calendar year, was a very strong year in markets, and you all benefited quite significantly. Overall, the pension plan returned positive 16.2% in calendar year 2019, and compare that to the bottom of page 17. You can see the estimated policy portfolio down about 12.3% through the end of last week on a year-to-date basis. So up 16.2% in 2019, year-to-date down 12.3%, with the majority of those returns coming from this most recent month of March that we're closing out here today, down about 8.2%.
Yeah, can I ask you a question about Brandywine? Maybe I'm misreading it, but as I look, it says the 1 year is 2.9.
Yeah. So yes, you're exactly right. So when I say calendar year 2019, and you can see it if you go back into page 28. So the 1 year number for calendar year 2019, that was up 9.3%.
I see. So Brandywine is a higher risk fixed income. Is its performance? It looks like it was way. Is that a good index that you're comparing it against? It was way off. Maybe that's not a good index. Well, I don't know. What do you think? It looks like it was underperforming the last 5 years pretty significantly.
Yeah, this is point in time type returns, and their trailing period returns can look very different than the benchmark, and really that's due to the broader nature of the benchmark and the fact that Brandywine does take concentrated risk within the benchmark, which we like. We like the fact that they do take more concentrated positions and have conviction in those positions. Now, lately, particularly in 2020 year to date, that's gone against them, mainly due to the fact that they've had more exposure to emerging market currencies, and also emerging markets, a lot of their economies are really driven by commodities. And I'm sure you're all well aware of oil prices lately just filling up your car. We've seen oil sell off significantly on a year-to-date basis. And then also, as we've seen the coronavirus impacts, investors tend to flee to the U.S. dollar as they see it as a safe haven asset. So the U.S. dollar has continued to outperform currencies, particularly within the emerging markets. So that difference there has really been the driver of why they've underperformed so significantly versus the benchmark. We still have conviction in this manager and conviction in the investment process. And as I mentioned before, we like the fact that they do take these active, high conviction type positions.
Well, the thing that I noticed when, in 2019, the high-risk fixed income had this banner year, didn't they? And they missed that as well. Now, maybe that's not a fair comparison.
No, hey, Jim, I'm sorry, this is Tim. If you look at page 28, you can see where Brandywine has been at that point historically, and they outperform the benchmark in every period. So the fact that their performance has moved negative after just a couple of months of this year, I think gives you an indication of just how big and how fast these issues have hit the world financial markets over the last couple of months.
Okay, I'll tell you what, there's always believers at the name, but maybe if you could give me the year-by-year returns for the last 5 years of Brandywine, I'd like to see that.
Sure thing.
Okay, thanks. Okay. Go ahead. What page are you on?
One moment. I was on page 17, and again, I was just pausing to see if there's any questions on the year-to-date performance for the pension. Okay, maybe moving along to page 18 again. What we're showing here is just an updated trailing period performance as of February 29th, 2020 for the DC plans, the combined assets reaching nearly $85 million as of the end of February. No major concerns with any of the underlying funds or their performance. You can see Tier 1, again, those are your target date fund assets. Those are for your participants who would like to invest their money into one product and forget about it for 40, 50 years until they retire. And the manager, Vanguard, in this case, is going to de-risk their portfolio generally from a more equity-heavy allocation to a more fixed income-heavy allocation. And you can see on the top line there, the Target Retirement Income Fund, how Vanguard participants helps protect their money as they near retirement or are in retirement on a year-to-date basis, where we see equities sell off over 20% and over 30% in some cases. Year-to-date, that Target Retirement Income Fund down about half a percentage point. So doing what it should do there, helping protect participant assets as they reach retirement and are in retirement. On page 19, Tier 2, these are the passive strategies within the DC plans. No major issues here, no major tracking error to the benchmark that we would find that we would consider an anomaly or anything out of the ordinary. These funds are meant to match the benchmark at a low cost. Tier 3 active managers, available participants have all performed pretty well, particularly on a relative basis year to date. No major concerns there. slides 21 through 31, these are all just a quarterly update through the fourth quarter of 2019. I'm not sure we want to go over that, just given that we've provided a more recent update on the pension and the combined DC plans through the end of February and estimates through the end of March. But I'll take your all direction there.
Well, does anybody want to get that earlier performance? Or are they satisfied? Tim, do you have any thoughts about that?
No, I think, there's good performance in 2019 has been mentioned. Everything has changed since then. So, when we do the audit reports and the actuarial reports later this year, they will be based on the using the 2019 numbers, and so it will not see what's happening right now. I think what we just talked about is probably more relevant to where we are, though, right now. And I think I'm not sure, Peter, if you're going to throw it back to Shane, but I think there are a few things related to this market fallout that impact some of the changes that we were planning to make in the fund that you probably want to go over.
Yeah, well, I was just, I'm glad you mentioned that. I mean, did we implement that new strategy that we approved at the last meeting? Or?
We did not. We were negotiating on some paperwork things, and they did not perform well during this market sell-off. As a matter of fact, it forced Aon to do another review, and they have changed their recommendation on the strategy.
Wow. Okay, so we're going to cover that now?
Shane, do you want to touch on that, or Peter?
Yeah, I can take that. Hi, Shane. So, as Tim mentioned, we were very close, I would say, to getting into Allianz, and which is a fund that's really, it's only open once a month. And as Tim had mentioned, there was just a couple more things that were being negotiated. But once, basically, starting in February, and which was, further turned bad for Allianz in March, was obviously the volatility in the markets, and they really just weren't able to execute on the strategy that they had quite a bit of success doing so with for the last, call it, 10 plus years. We've had multiple discussions with them. We continue to have discussions with them. You may have seen in the Wall Street Journal and other, periodicals yesterday and the day before, Allianz has actually shuttered 2 of their higher alpha risk strategy funds, which are very much akin to what we are recommending to you, just at a lower risk level. But they have shut the 2 highest risk strategies. They are continuing with another 20 plus strategies that they have that, again, are at lower risk. But after our discussions with them and how they performed over the last, call it, 45 days, we weren't comfortable with the risk controls that were in place and how they went about vetting the portfolio given the risk environment. To maybe summarize it in a couple sentences, there's really 2 parts to the portfolio. There's the option selling part, which you can almost think of as almost like a beta strategy. But then on top of that, they overlay that with some fundamental options strategies. And basically the beta part lost and was doing pretty well as expected. But instead of just sitting back and trying to slowly recuperate those losses that they experienced in kind of the second half of February and through most of March, they used that other part of their portfolio, the fundamental discretionary part, to try and recoup losses faster. That went against them as well. And what we've seen is just really outsized losses given what their historical performance has been. And even when we stress tested their models for downside scenarios, and this has been a really bad downside scenario, I'll give them that, but it is still well outside of the bands of what we would have expected. To even try and put like a standard deviation event term to it, I don't even think does it justice. It's been just that absurd.
How much did they go down, since February 1st?
So they run this in multiple versions, and I believe the one that we were moving into was what they call the 350. I don't have the 350, the Alpha 350 stats in front of me, but I do have stats for a couple others through month to date through Friday, and I'm pulling that up right now. And we can kind of extrapolate from there what the 350 would have done. So their equity 250 strategy, which would be slightly lower risk than what we were expecting to put you into, just month to date lost 36%.
Wow. Boy, we got
So yeah, and I would say, so the 350, it's almost a linear progression. The 350 is what, another maybe 30%. So the 350 was probably down about 45% just month to date.
And that was the one we were going?
Correct.
Wow. Well, I'm sure glad we didn't do that.
Yes.
I gotta laugh. I mean, it's incredible.
So Allianz, we to maybe bring this full circle, and I'll definitely answer any questions you might have, because this has been a big topic of mine. I do have one client that is invested in this strategy, so I'm living through it with them. I have two other clients, one of them, including you, were right on the cusp of going in. So yeah, dodged the bullet there.
Did we send our resolution to go into it, Tim?
I'll talk to Susan about that. It depends probably the way it's worded, but it probably makes, would we resend the resolution formally to, I'd have to look at it to see what the wording was. It may have just authorized us to take certain actions. We'll look at it.
We don't want to take risks. I wouldn't think.
Yeah, we'll take a look at it, and we'll bring something to you that'll make it official that we're not moving into that product.
Okay. So it's clear. I mean, we are not going to put any of our money, right?
We are not. That's correct. In the past, like we talked about the UBS property fund that had a rough stretch last year, and had reviewed that, and I don't remember what the official term you used, Shane, was, but it was, you didn't move UBS to sell. You still saw them as a good manager. With this Allianz product, you've moved them to sell.
Yeah, this is correct. Sell is the worst rating that we give firms. So what that means is our recommendation is if you're invested, redeem, and if you're thinking about investing, don't. So, yeah, that's
sell into a down market. That is that's okay. I guess very telling.
It's been, I mean, this is still early days, and even I've lived through a couple crises now. This one's obviously different. They always are a little different, but there's firms there's firms that are going to fold, and there's strategies that are going to not perform, and this happened to be one that just, I don't know that we could have done anything different to have recognized what was going on at Allianz. So it's not, this is very much a firm-specific issue, not a strategy-specific. And what I mean by that is we still are very big believers, and even more so right now, on the whole concept of equity insurance risk premium. And right now, given where volatility is, the next few months are going to look very good for other managers that can implement in a risk-controlled way to reap the benefits. It just happened that the implementation aspects on the Allianz side was not as strong as we expected or hoped or wanted. So.
And then, Shane, I don't know, unless there's other questions on Allianz, do you want to touch on UBS really quickly? It looks like there'll just be a delay in our redemption there.
Yeah, so what we're seeing here, maybe just a quick backdrop, we're just starting to see, again, early stages on kind of the fallout of what this crisis means to certain areas of the financial markets, market segments, things like that. But as it pertains to real estate, we are starting to see and hear that open-end funds, which is kind of a misnomer in terms, but in normal market conditions with UBS, you'd be able to pull your money out on some type of a regular, frequent basis. But they've had such a redemption queue that they were going to, the plan, say 2 months ago, was to do kind of a pro rata slice for all clients who wanted out. So the expectation was that you would finally get your money out maybe over a 18-month to 2-year time period. And then every quarter you would get some small slice, this pro rata allocation. Well, what they've done now is started to implement gates. And what gates mean is just basically a lockup in capital, at least for some extended period of time. UBS is probably the first open-end fund that we've seen that has put up gates to go on to this level, but we expected this to happen. We expect other open-end funds to do the same, and we're seeing stress in other markets as well, so what I would call closed-end real estate funds. So we're not, what UBS is doing is not, is well within the realm of expectation given the market environment. But the end result is, yeah, you're not, MSD and really no clients are getting any money back at this point in time.
Well, were we trying to cash out of UBS?
Yes, that was a property fund that we talked about. We've talked about it a few times over the last several months.
Was there a sell rec? Did we pass a resolution to reduce our holdings?
We did. And we were expecting, I think right around now, the first distributions. And as of, I mean, I think I first heard of it last week, they've suspended distributions. I think what you sent me, Shane, just said right now through the first quarter. But I'm sure that will continue to be evaluated.
And Trustee Singer and another group, in this case with UBS, as Tim had mentioned earlier, to contrast this with Allianz, we didn't put a sell rating on these guys. We put them more of in a hold rating. So we left it up to the discretion of individual clients and consultants, given their circumstances, on what they wanted to do. So I would say across our client base, where we have many, many client exposures with UBS Trumbull Property Funds, similar to you, I would say it's been a mixed bag, probably almost split 50-50 clients putting in redemptions such as we have here, and other clients who took advantage of certain fee breaks and stayed in. So we don't think the wheels are falling off with UBS. It's more they run into issues and we think there's better managers. But what makes things a little worse here is, yes, we put in our redemption notice. We knew 2 months ago that it was going to take 18 months plus to get our money back. But now with what's happened in the markets with over the last 45 days, UBS has taken extra steps to basically, reduce liquidity. And Tim, you're right. I think you probably got this notice. I think it was yesterday from UBS, basically stating that your redeemed value is $0.00 for this quarter. So I opened that up yesterday.
Well, I mean, is that a common feature seeing with these real estate funds, or is this something where UBS is ahead of the curve? Or?
Oh, I wouldn't say UBS is ahead of the curve. So, I mean, that's been a question that we've been asking and our clients have been asking for maybe the last 3 to 4 months. Were they ahead of the curve in the write-downs in their retail portfolio? I think the answer there is probably no. I think they probably had more exposure than the average manager in the retail sector. Think of malls, for instance, just been really beat up. They've had overexposure there, so their write-downs are larger than their peers. But initially, when those write-downs came in, those were the questions we were asking. Were they ahead of the game? The final answer isn't there. We haven't seen as large of write-downs from their peers in the retail sector, but I think UBS probably just had not as high quality retail and probably an overexposure relative to their peers. So that's the first time we started asking this question, are they ahead of the game? They probably are ahead of the game now in terms of putting up gates, but that's only a function of the very large redemption queue that they've built up over the last year or so because of those write-downs.
But
so
the ability,
I wouldn't give them any props for being ahead of the game.
And is that one that you inherited from us, or were you the ones that recommended putting us going in there?
Well, we inherited it from, it was there in the plan, but I don't want to try and shirk my duties or our duties. We were still, when we came on board with you guys, I don't know, almost 2 years ago, UBS was buy rated. And we still have plenty of clients that are in it, so. But to answer your question, we did not put you in that.
Okay. Any other good news?
Well, we're starting to see opportunities. So, I mean, maybe what you want to, maybe if I could spend 2 minutes on what we're doing as a firm. So, holding lots and lots of internal calls, scouring the different market segments and asset classes for opportunities. Certain areas of the market, it's still too early. So I'm thinking private real estate, private credit, or private equity areas where we haven't even gotten year-end valuations in yet. But so just too early to tell what opportunities might present themselves there. We are on a real estate side. What looks more interesting right now is potentially public market. So think REIT securities, so publicly traded real estate securities. There seems to be a huge disconnect between where they're trading at and the underlying NAV. So our group, Townsend, is on top of that. I wouldn't put it past us if we roll out some type of fund to take advantage of the opportunities there in the public market real estate side. A little too early to see what the opportunities are going to be on the private market side. But as everyone might expect, it's probably going to be distressed credit oriented, whether it's private equity, real estate, or liquid alternatives. So that's where we're at now. Trading costs are super high. We're not recommending clients doing any kind of transitions, not that you guys are in one, but whether it's equities or fixed income, liquidity is strained. It's gotten better than where it was, say, 2 weeks ago, where hopefully that was the peak or the trough, however you want to describe it in terms of volatility. And yeah, it's really, as Peter had mentioned at the very onset, we're not ready to go completely back into equities, bringing our clients back up to their policy weights, but what we're most concerned about is staying within the policy and where needed, rebalance to the lower end of the equity weights. And we're just waiting for the opportunity to maybe go a little more in. So we're doing a lot on the fixed income side as well. We're thinking about maybe increasing credit exposures, reducing duration. So we're waiting on some analysis to come out. So there might be some recommendations on that front in the very near future. And just one thing to put in everyone's mind here, and really for Tim and John, and I guess the whole committee, we know that during these stress market environments in fixed income, and specifically investment grade, there's going to be downgrades. So these are what were high quality securities that are going to fall to, you know, distressed or high yield. And then what do you do about that? So we expect that your fund managers will probably be coming to you in the next month or so, notifying you about downgrades, notifying you what the current guidelines are, and seeking guidance on what to do. So right now, I expect in the next couple of days, we're going to have better guidance ourselves on it, but where this is really leaning is it's going to be the recommendations we give you when your managers come to you asking you for this lenience is going to be very much specific to the situation and to the manager and to the client's ability to take on additional risk. So what I'm saying here is when this happens, and it will, that we're going to have to treat each of these events on kind of a one-off basis. I'll stop there. It took way more than my 2 minutes. So.
Yes.
Well, I mean, Tim wouldn't make a change without getting a recommendation from you, right?
I'm sorry, what was that?
I mean, when you said the managers are going to come to us asking for changes. I understand I understand what you're saying.
So what I meant there, just to clarify a little bit, we fully expect your not just your fixed income managers, but almost any fixed income manager that's playing outside of treasuries that has credit exposures, investment grade credit, that there will be downgrades. And each client's guidelines or mutual funds prospectuses are written a little different on how to treat those downgrades. So in a very kind of archaic, very rigid way, a lot of times clients have in their guidelines or prospectus that if an investment grade security falls outside of the benchmark and gets downgraded, they automatically have to sell. We don't think that's a good approach. We want to give the managers flexibility. Let's evaluate each situation that happens, because there could be value there. We don't want to force our clients to have to sell given the guidelines that are currently written, given the environment that we're in now. That was the only point I wanted to make.
So your overall, we would accept the recommendation, and it sounds like. And then what, would Tim talk to you before he?
Yeah, we wouldn't take action without talking to the board. So anything that we get, we'll discuss with Ann, and we will come to the board. We're not making any actions on any of the securities in the portfolio without board approval.
And this isn't an immediate thing. We fully expect this to kind of start seeing these downgrades. They're going to be in the headlines. It's probably going to be over the next, call it 3 to 4 weeks out. We'll probably start seeing some of the first ones to hit, and it'll probably just progress for probably 6 months afterwards. So. And the point I wanted to make is we're expecting this, we're on top of it, and we want to treat each situation separately instead of just having blanket recommendations or following guidelines which really weren't written for these times and market environment. So,
okay,
no immediate action.
Anything more on the pension update agenda item? Are we ready to move on?
All right.
Tim, did we cover everything?
Yep, I think we've covered that one. The next few items are mine. Do you mind if I just move forward, Jim?
Sure.
All right. Thank you both, Shane and Peter. All right. So next we're going to move to the operating fund portfolio.
Should we stay on?
And that's the sheet that we look at every month for squares. And so I'm just going to go through this. Try to go through it pretty quickly. Total portfolio size is a little over $616 million. Our yield to maturity, so this is based on the prices at which we bought securities, and their yield is 1.82%. Remember, the benchmark that we compare to is the 1 to 3 year Treasury. We've seen a dramatic fall in rate, so the benchmark right now is just under 0.25%. The benchmark turns over entirely every month. Our portfolio turns over relatively slowly. For example, we had about 87 million of new securities in March. Our yield to maturity was 0.72, so higher than the benchmark, but we had those spaced throughout the month at different times, and we don't invest in just treasuries. So if you look to the sector allocation in the upper right, you can see right now we're very heavy on Fed agencies, about 56%, getting close to our policy limit of 60. Our commercial paper, we're usually close to 25 on that. Let's drop just a little bit. The Fed agencies and the treasuries are, safer. We only invest in very safe commercial paper when we invest in commercial paper, but we are focusing more on treasuries and agencies right now because they are the safest things that we have in our portfolio. We get a little better yield on the agencies. And just another note that ties into this whole market thing we were talking about. Very short-term treasuries, I'm talking like 1 month and even 3 and 6 month treasuries at times in the last couple of weeks have actually had some negative yields. So we do see yields coming down, which is going to bring our overall yield of our portfolio down going forward. But we are in compliance with the policy. We are working to protect the funds, make sure that they are available. Safety is the most important thing when we're talking about investing. We look at safety, at liquidity, our ability to get funds out of what we're investing, and then yield last, and that's certainly true now more than ever. The maturity distribution at the bottom right just doesn't look a whole lot different. We got about 71% coming due in the first year, so we are trying to stay more liquid as well. I think that's the best thing to do for our operations. We continue to have expenses. We continue to fund projects, so our portfolio again turns over, generally mostly within a year. Any questions about the operating fund portfolio?
So this is Brian Holscher. For everybody on, we're going to do one more item, and then we're going to take a break, and then Mary and G will take over and start addressing budget items. So just a warning ahead of time. Go ahead, Tim.
All right. So I've got one more item, as Brian said, before we turn it over to Marion. Here, I think, is where you'll find your good news, Jim. So we're going to look at the forward direct placement refunding bond update. So there is a PowerPoint slide. We reviewed this a little bit last month, but I want to go over this again because we actually closed on a transaction to refund some bonds for savings in the last few weeks. So I'll start on just page 2, just quick summary. We don't have the ability to do tax-exempt advance refundings anymore. We can do taxable advance refundings, which we did last year. A couple of banks came to us with this idea, which would be essentially to enter into forward contracts to lock in low rates and then issue tax-exempt bonds in the future when our existing bonds are refundable. And so the reason we would do that, excuse me, on page 3 would be quick execution. If we're not marketing we're just dealing with a bank, not marketing to a whole bunch of institutional investors, there's a lot less paperwork. Actually, the proposals we were seeing provided better savings than what we would have gotten in a taxable advance refunding. We have a certainty of the sale and the refunding prices, and cost of issuance also are lower. So if you recall, there was an ordinance. We set some parameters. We were targeting bonds that would yield not less than a 10% net present value saving. Again, we set parameters around cost of issuance, on the redemption dates and true interest costs. And so all of those were kind of built in. So we had some flexibility to move within those parameters. At the time that we presented this to you, we thought there was about $150 million of refunding candidates that we thought we could get a minimum 10% NPV savings on. So if we look at page 6, you can see the results of what we did. If you add that up, we actually had found $250 million worth of bonds outstanding that had more than a 10% net present value savings. The true interest costs, you can see, are some of the lowest we've ever seen on any of our bond issuances. The 2021 bonds we refunded, the true interest cost of the refunding bond is 1.6, and then it moves up to 2.6 for the 22 and 23 bonds, and then right about 3% for the 25A. And those NPV savings at the bottom range from 15 to over 20%. So that is huge savings. These were savings that did not exist about 5 months ago when we did a refunding, and that, again, is an indication of how quickly and how much rates have come down. On page 7, you just see some numbers on the refunding. For the bonds that we refunded, previous debt service was about $382 million spread out over 23 years. These new bonds have $310 million of debt service over that time, so that's a savings of $72 million over those 23 years. I just want to go over this real quick on page 8. This just kind of gives you an idea of how much rates have moved. So this is about the last 15 months of municipal interest rates. This is a curve, but it shows you kind of what's happened. So about 15 months ago, municipal yields were close to 3% for 20-year bonds. You can see the star that says 2019C. That is where we priced our refunding about 5 months ago, which was right about at 2% yields. And then the forward refunding star at the very bottom, you can see is where we priced this refunding. And then almost immediately, actually the afternoon, we priced these in the morning. That afternoon rates started to go up and just shot up over the next couple of weeks to well below they even started 15 months ago. So that's the kind of disruption we've seen in the market. Municipal market has essentially been closed, except for maybe until the last couple of days for the last few weeks. So that's, again, the flexibility that you approved. If this kind of transaction let us get this done in a time frame, we would not have been able to get it done in the more traditional sense. And we got greater savings as well. So, so there's some good news. Just some quick considerations. These savings are delayed. We didn't issue the bonds now. They get issued over the next few years as the bonds that are getting refunded become refundable. And then the ordinance that you approved allows us to continue to look at this through 2020. You know, rates, we'll just see what they do. Expect continued volatility. We just want to be ready to take advantage if there are more opportunities later, though there's nothing imminent right now. Then the very last page of that presentation just shows you the combination of the refundings we got with this refunding as well as the one 5 months ago. That's 171 million lower debt service over about the next 25 years. So that's about 6.8 million per year on average. Pretty significant savings. So.
Tim, on slide 8, is the reason that jumped up that is just a risk-off reaction that even issuers
that's
like
right,
MSD?
Jim, you can see it wasn't that long after the 2019 C-Star. You see things headed a little lower, but mostly kind of hanging steady. And then you start to see the impact a little bit of some of, you know, coronavirus being known. The Fed had pumped in some liquidity. Rates are falling. But once we hit a point where it was risk off, money flew to U.S. Treasuries only, and that was it. People weren't touching, for the most part, even municipal bonds. And so that's why you saw that kind of, you see that kind of dislocation. Now with the stimulus package that the government passed, what was it, last week? They put in some provisions too that allows them to also help liquidity in the municipal market. So that's why you've seen a meaningful comeback. But as of at least the end of last week, it had not even yet reached back to where we price. So we feel pretty fortunate about the timing that we were able to execute on this one. Any questions about that? Okay, then it sounds like we're going to take a break.
So everybody on the line, Trustee Singer, we're just going to take a break. We'll check in with the board members. We're going to aim for about 5 minutes to give everybody a chance to refresh before we start with Marion G.
Okay. Thank you.
Everybody on the line?
I can hear you.
Always.
Okay, we're ready to go, Trustee Singer.
Okay, Marion, you want to take over?
Sure. The first item that I'm going to cover is item number 6, which is a proposed resolution that relates to our rate modeling support and the feasibility study. So back in 2017, the district issued an RFP for a consultant to provide rate modeling support, preparations of our feasibility studies that we need for our bond issues, and also assistance with public communication relating to our stormwater initiatives. Ref Tellis Financial Consultants was selected as a result of that RFP. And this particular resolution is to exercise the third of 4 option year renewals with Ref Tellis. So if there's no concerns by the board, this will appear on the next board meeting agenda. Are there any questions about this item? Okay. If not, I will move on to item 7. Item 7 is a budget transfer resolution. It actually relates to the Fort direct placement bond issue that Tim was talking about earlier. Normally when we issue bonds, there's funding from the proceeds to pay for cost of issuance fees. Because these bonds will not be issued until a future date, there is no proceeds to pay for that. So what this resolution does is it allows us to move funds from an existing debt service account in the amount of approximately $506,000 to pay for commitment fees relating to the bond issue. So we're transferring money from a debt service fund to a cost center in Tim's operating budget. And again, this is to pay for commitment fees relating to the bond issue that Tim described. So are there any questions about this transfer? Okay, hearing none, we will jump over to item number 8, which is our FY21 budget presentation. And the board should have received an email copy of the presentation, and we also handed copies out to those members here in attendance. So I'm going to assume that everybody has that, and so I'll go ahead and get started. So I'm here today to present the district's strategic business and operating plan, as well as our preliminary budget for fiscal year 2021. If you move to slide 2, the purpose of today's agenda, again, is to review our strategic business operating plan. Brian will cover that. We will also review our FY21 preliminary budget, which includes both our operating and our capital budget. I will review the operating budget, and Rich will talk about our capital budget. And then we'll wrap up with kind of the next steps in the budgeting process. And I will talk to you about also some proposed reductions that are not reflected in these numbers. So,
Marion, can I interrupt you a second? I've got the email with these large documents, which I get, they're the 2 budgets. Is that are those the documents you're referring to?
Yes.
You're going to be using?
Yes, okay. It is. You should have a presentation. The first slide of that presentation should read FY21 Strategic Business and Operating Plan and Preliminary Budget Review.
Okay.
Okay, so Brian is going to describe or cover our strategic business operating plan, so I'll turn it over to him.
Okay, this is Brian Holscher. I'm going to do the next 3 slides. Stop me if you wish while I'm presenting. I'll make sure there's plenty of time at the end if you have any questions. So on slide 3, We haven't provided the entire strategic business and operating plan in these documents, but if you look at the preliminary budget documents we had sent to you before, they're on pages 18 through 50 of that budget document, and I'm going to go over some highlights that are in that document. If you turn to slide 4, our strategic business and operating plan has 4 goals: to deliver consistent, high-quality customer service, comply with all legal and regulatory requirements and schedules, minimize customers' rate increases, and be accountable to the St. Louis community. Those goals have pretty much stayed set since we started the business plan process. As you can see, most of those are simply just an outline of MSD's relatively narrow task as to why we're created and the functions we provide. So if you turn on to page 5, the guts of any annual review is the strategies that are part of the strategic business and operating plan. There are 6 of those that you'll find in the plan. The first one is to form, educate, and partner to build stakeholder understanding. Number 2 is to manage the district's cost and revenues to optimize financial impacts. 3, integrate and improve the district's business processes. Number 4, promote appropriate standards through proactive regulatory and legislative involvement. Number 5, address customer and regulatory needs through a comprehensive infrastructure management program. And 6, to create a learning and business-oriented culture based on competency and accountability. So that's the title of the 6 strategies. Those do adjust as our business environment changes. If you look at the business plan in the budget at some time, you'll find that each one of those strategies have 1 to 6 different objectives in each one of those strategies. Each one of those objectives is broken down into a set of year 1 milestones, and for this purposes, year 1 starts July 1. Year 2 milestones, and then a combined year 3 through 5 milestones. Again, those documents are in the budget documents we previously sent. There's no budget item that we will present today, especially the incremental budget items, which are new items. They will not be considered unless they're in the proposed strategic business plan. If you look at the business plan that's in the budget, you'll also find a mission statement that has never changed. It's pretty much stayed the same. We've reworded a little bit. And finally, our overall vision statement, which is quality service always. As with the budget, you can ask questions now about that business plan if you have any. You can ask questions to the staff between now and our next committee meeting, and we'll also have availability to ask staff questions at the next committee meeting. So I guess I'd ask, do the board members or any of the board members have any questions regarding the strategic business plan at this time? Okay, I am going to pass back over to Marion to do the presentation for the proposed fiscal year 2021 budget. Marion?
Hey, thank you, Brian. I'm going to move over to slide 7. As this slide shows that the district is proposing a balanced budget as directed by charter. The budget totals $745.3 million of revenues and expenditures. The components of each will be discussed in more detail as we go through today's presentation. Moving over to slide 8, there are certain key points of the preliminary budget that I do want to cover with you. Number 1, the general fund budget includes $1.5 million of increases for salaries and FICA, excluding the incremental budget items that Brian talked about or mentioned earlier. There are $1.9 million in incremental budgets that are tied to the strategic business plan that are included in the budget. Just for the purpose of the new board members that have not gone through this process, our incremental budget items are budget initiatives that are derived from the strategic business plan. We show them as separate line items and discuss them in detail with you in addition to the routine items that are in the operating budget. So I will give you a little bit of information on what that $1.9 million consists of. 1.1 million of it is technology initiatives consisting of an upgrade to our Oracle financial systems. That's about $600,000. $300,000 for mobile technology, and then another $200,000 for data management services. So that 1.1 million will be placed in our IT department if it's approved by the board. There's an additional $700,000 of incremental items that are in our engineering department's budget, and those items consist of an infiltration study, inflow and infiltration study that was requested as part of the rate commission process. That was a $300,000 item. There's also $400,000 included for water line investigations. Moving on to the next item. Overall, the general fund budget increased by about $3.9 million from our FY20 levels. That's about a 1.9% adjustment. Our total capital budget is $403.3 million. Also included in our budgets is the assumption that we're going to issue about $166 million of additional revenue bonds. The budget was developed to align with the rate proposal that was given to the Rate Commission in March of 2019. Moving on to slide 9, I'll talk to you a little bit about the revenue components of the budget. As shown earlier, the district's revenues are projected to be $745.3 million. The largest portion of our revenues, of course, are wastewater user charges. That's depicted in the blue portion of the graph. Our wastewater user charges are projected to be about $435 million, or 58% of our revenue budget. The next largest portion is our revenue bonds that I mentioned earlier. We are projected to issue about $166 million of revenue bonds. That's 22% of our revenues. Then we have our stormwater taxes that are about $43 million, or 6% of our revenue budget. Next is our investment in other income. We're projecting that to be $12.3 million, or 2%. I will mention this is an item that we will be taking a look at given recent events, so this may be an item that we will tweak when we bring the final budget back to you. And finally, we're proposing to use about $90 million of existing fund balance. Okay, next, if we could move to slide 10. I just want to talk to you about the proposed impact of our scheduled rate adjustments. In FY20, a typical residential customer using 6 CCFs of water, that's about roughly 4,500 gallons of water, would pay about $55.60 per month. As part of the rate commission process, the district proposed, or actually the board, in the rate recommendation that was received from the rate commission, sorry about that, the district proposed a 1.5% rate adjustment. That would increase the typical bill by about 83 cents, moving it from the $55.57 to $56.40. We have seen a decline in usage of our residential customers. A couple of years ago, the typical bill was about 7 CCFs, which was about 5,200 gallons of water. That's dropped to about 6, which is about, again, 4,500 gallons of water. Moving over to slide 11, I will talk about some detail regarding the budget expenses. So the total preliminary district expenses, again, are equal to our revenues, so they're about $745.3 million. The largest portion of our budget is our capital improvement and replacement program. That consists of $403.3 million, or it's about 54% of the district's total budget. that capital program is divided into two components. We have our wastewater program, which is about $383 million, and we also have our stormwater program, which is approximately $20 million. The next largest portion of our operating budget is our operating budget, which is about $220.7 million. That's 30% of the total district expenditures. And then finally, our debt service is about 16% of our budget. The debt service is the principal and interest payments that we make on our bonds. We're projecting that number will be $121.3 million. Hopefully, Tim will be able to find some additional bonds that we can refund, and this number will come in below projections. Okay, next, I'm going to move to slide.
Did somebody have a question? Okay, I'm sorry, Mary.
Okay. Next, I'm going to move to slide 12 and give you some detailed information regarding our general fund budget by department. You will see that budget listed for each of the departments here at MSD, in addition to our rate commission budget and our civil service commission budget. So I'm going to just kind of touch on some highlights surrounding those variances that you see there from FY21 to FY20. First, our operations department budget increased by about $2.5 million, or over 2.1%. And the primary reason for those increases are we're projecting a $2.1 million increase in our contractual services, and that consists of about $600,000 for additional machinery and equipment, another $567,000 for ash hauling. That is when we burn our sludge at the treatment plants and we have to haul that to the landfill. In addition, there's roughly another $450,000 for instrument repair services and sewer cleaning services. Also in operations, there was a $1.5 million increase in personnel services. That's primarily consists of salaries of $1.2 million, in addition to another $300,000 for group insurance and pension expenses. Our operations department consists of our largest number of employees. They contain about 600 of the 1,000 employees here at the district. There are some decreases as well in the operating department's budget. There's about $400,000 of decreases in their capital outlay budget. That's due to the need for fewer vehicle replacements. In addition, there's a $300,000 decrease in their utility expenditures as well. So again, overall, we saw an increase of about $2.5 million, or 2.1% for this department. In the Secretary Treasurer's Department, you'll see an increase there of $1 million. That's due to the proposed ballot initiative relating to our wastewater and charter changes, as well as $280,000 of additional expenses relating to our information governance initiative. In the Executive Director's Department, there's an increase of about $151,000, or 3.8%. That is comprised of community outreach programs related to the First Source hiring program. That's a $150,000 line item that was not included in the FY20 budget. In the General Counsel's office, there's an increase of about $496,000, or 14.7%. That relates to additional expenses, primarily for outside counsel. This will be an item that will be revised as well when we submit the final budget. I expect that you'll see a decrease there. In human resources, there was an increase of about $101,000. Most of the increase related to contractual services for a compensation study that will be conducted. That was about $277,000. And that will be offset, though, by a decrease in personnel cost of about $183,000 related to our general insurance and our pension contributions. In the finance department, there's an overall increase of about $102,000. That's primarily due to some building improvements that we have to make here at our Market Street facility. That increase was about $400,000. That's primarily to upgrade the elevators that are here. We've had some maintenance issues with those elevators, so we're having to make some improvements there. You'll see a decrease in the personnel cost of about $183,000. Also, our contractual services related to our call center and our contracts that we have with our water agencies to get water data so that we can bill, that amount is projected to increase by about $284,000. But we do have a reduction of about $198,000 due to the rate consultant no longer being utilized in FY21. We, as part of the rate commission process, increased the consultant budget in our FY19 and FY20 budgets. That process is completed, so that line item is not in the FY21 budget. Also, there's a decrease of another $336,000 related to pension contributions in the defined benefit plan. We've had a number of individuals in finance that were in the defined benefit plan that have retired, so those expenses will no longer be incurred. In the information systems department, you will see a decrease there of $1.3 million in total. That decrease actually relates to incremental items that were included in the FY20 budget. John, instead of paying temps that we were utilizing for several years to provide services, decided to hire a number of those temps. That resulted in a $717,000 savings in the temporary services line item in that department. And also, there's a reduction in computer supplies and publications of about roughly $204,000. In addition, there was a decision made to shut down our Dallas data center. I think we're using a local data center now. That saved us $207,000. And then finally, in the engineering department, you will see a decrease there in total of about $1.1 million. That decrease relates to a reduction in personnel services of $701,000, which primarily related to declines in our pension plan expenditures. Are there any questions that I can answer regarding the preliminary budget? Okay, if not, next Rich is going to present our capital improvement budget, and then I will follow up with the next steps in the budgeting process. So I'll turn it over to Rich.
All right, thank you, Marion. I'm going to be beginning on slide 14. Today I'll be providing a summary of the district's proposed fiscal year 2021 capital improvement program. You should have all received a copy of that. It was actually a separate book from the district's overall budget book. It includes all the projects that we will be bringing to you on an individual basis throughout the year, both design and construction, both wastewater and stormwater projects throughout the year. Today's presentation, I'm going to break down the program, summarize the different aspects of the program and the different categories and the results. I'm going to be given a high-level summary. There was an additional presentation that was provided in your packet and sent out earlier that's labeled, it's a similar presentation to this one, although it says detailed summary. That particular handout's about 35 pages, actually discusses some of the individual projects. My presentation today, I'm not going to get into that. if you go through that or have questions on that, I am available to discuss any one of those projects. So moving on to page 15, an overall summary, as Marion pointed out, just a little bit over $400 million in the capital program this year, 376 million in new projects, and there are about $27 million in projects that were planned for fiscal year 2020, and they were not completed, and they will be moved on to the new fiscal year. So we will be covering a little more detail on that as I go forward. Moving to slide 16. As is pretty typical, our fiscal year CRP projects is primarily, a big part of it is a wastewater program. About 95% of the program is wastewater projects, and about 5% of the program are stormwater projects. The wastewater projects amount to about $360 million worth of 134 projects at $360 million. And on the stormwater side, we have 26 projects at approximately $18 million. Please note that a lot of times you'll see different numbers, like it says new projects 160. A lot of times those projects are broken up or even combined. So if you see some inconsistencies on the number of projects in my presentation, that's usually the reason, is that we may be having appropriations both out of stormwater and wastewater on a single project, or be dividing that funding up. So that's why we ended up with 160 there. Next is page 17. This is a breakdown of our wastewater investments by the number of projects and the value of the location within the district of where that work's going to take place. Again, this is about 70% of our overall projects that we're doing this fiscal year are actually located in St. Louis County. They're primarily part of the SSO program to eliminate sanitary sewer overflows, which are primarily located in the county. You'll see that shift in approximately 2023, where we'll be doing some larger projects in the combined sewer area, more closer in the city. 14% of the work we're doing, are 33 appropriations for about $48 million, are district-wide projects. I actually brought one of those to you today. It's where we're doing rehabilitation of the sewer system, usually our lining projects, our cleaning projects, or CCTV projects. We consider those district-wide, where we're doing work throughout the district on the system that we have. And then 8% of the work, of the wastewater work that'll take place, 10 appropriations for about $30 million, will be working actually at our treatment plant, at one of our 7 treatment plants in the system. Moving on to page 18. This actually shows the source of funding for the capital program. Again, the majority of the projects by dollar amount are wastewater projects, and those are funded from our sanitary replacement fund, or the actual user rates that Marion talked about earlier. 6% of the program comes from our general fund. These are the green infrastructure projects I bring to the board, and some of our district-wide vendor services. Those are taken from the general fund primarily because the projects are non-capitalizable. The project's capitalizable, we'll take that from the sanitary fund. And then the remaining projects that we have planned will come from our stormwater taxing funds, either the OMCI taxing fund or our 2 district-wide stormwater funds, both for operation and maintenance and repair services. On slide 19, as you're aware, we are in fiscal year 21, we'll be re-administering the OMCI taxes in 6 of the OMCI districts throughout the district, based on input from the public. With that, this chart shows the tax rate that we're going to be charging and the expected revenue in each one. And as you recall, one of the things with returning these back on, there was request whether the funding could be available to the municipalities within each one of these OMCIs. So what we've done here is shown the amount of funding that will be made available to the municipalities should they want to do stormwater work on their own. So total revenue generated is about just under $8 million, and about 3.6 million of that funding will be available for grants. 5 of the 6 have agreed to do that. The Maline Creek OMCI, all that funding will be on projects performed by MSD.
Rich, before you go on, trustees, these.
Can I ask Rich a question about that slide?
Yes.
Is the grant in addition to the 7.9 million or part of the 7.9 million?
It is part of it, Jim. It is the it's a breakout. We probably should have been clear on that.
And then is the grant, is it an MSD funded grant, or is it from like the EPA or state of Missouri or some other organization?
It's actually a grant from the revenue generated. It's an MSD grant. In other words, it's money generated within the OMCI that we're making available to the municipalities within each subdistrict.
So it's generated by the tax, but we're doing a grant to the municipality to do the work instead of us doing it. Is that the idea?
That is correct.
Okay, got it. Okay, thank you.
So trustees, in case you have any questions, what we're proposing on the OMCIs is the same as what I brought to you back in January. It hasn't changed. You directed us to put this into the budget for your consideration. We've met with all the parties who've expressed any kind of interest, and we have heard nothing that would lead us to change the recommendation. So based on what we previously presented to you, I think 2 or 3 months ago, this chart and what's in the budget is exactly identical in raising the taxes in these 6 OMCIs. Go ahead, Rich. Thank you.
Thank you. And if there's any other questions on that, feel free to reach out to me. I'd be happy to answer that. My next slide is slide 20. This is where I break down the fiscal year CRP both for engineering and construction. We take the overall value of the CRP and indicate how much work's being done by our consulting engineers and how much we'll be bidding out to the contracting community. This number here, about 17% of the overall program will be used for engineering services, or $64.3 million. And 83% of the program will be put out to bid on the street for construction services, about 80 appropriations for approximately $312 million. Just some perspective on this. We started our consent decree program back in 2012 and 13. Obviously, there was a lot of ramp up with the program and doing a lot of engineering design work in order to build all the work we've been doing on an annual basis. At that time, our engineering was about 30% of our overall budget, and construction was about 70%. So now, as we move through the program, and it's slowly but surely ramped up, this is, in the last 10 years, this is the lowest amount of design services we've actually had. In other words, this work's actually resulting in constructed infrastructure and repair of infrastructure throughout the system, which is what we always anticipated, but it's really gotten to that point. And to even further dive down into it, the 17%, a portion of that actually is engineering services that we're using to supplement our inspection staff. In other words, our construction management consultants we hired are part of that 17%. So there's a good story to tell there in that a lot of our work is going into construction of infrastructure in the inspection of that infrastructure. So that's a good story to tell. Contractors are happy, the consultants are still wanting more work. Any questions on that? All right, I'm on page 21. Early on, when I gave the overall summary, I talked about projects that we consider carryover projects or continued projects. These are projects that we had every intention of completing in fiscal year 20. Just for various reasons, weren't able to get those projects completed, and therefore are carrying over to our fiscal year 21. There's a total of 10 projects there. On the wastewater side, you see some of the different reasons why projects might carry over. On this particular one, all 6 of the wastewater projects are basically, we're waiting either to coordinate with some other project that may not necessarily be a district project. Maybe we're coordinating with a municipal project or a private development. So we've delayed or working with them. So there's 6 of those projects. And then there's also construction phasing, where we're out there doing a phase of a project that the first phase hasn't completed, so we weren't able to appropriate the second phase or the third phase on the wastewater side. On the stormwater side, these can be more complicated. Again, a lot of times there's various reasons, easements, scope changes, things like that. Again, these issues with the 4 projects on the stormwater side had to deal with coordination with others. And typically, coordination with others on stormwater jobs are utility-based or could be based on a municipality, coordinating with the municipality on the timing of the project, either with the project they have going or some other reason why they want us to delay the project. So there's a total of 10 of those projects, 6 on the wastewater side, 4 on the stormwater side. And actually in the budget book, there's a separate tab that identifies each one of those individual projects, and it will state in there why that project was delayed. Page 22, fiscal year 21 CRP contingency project. What a contingency project is, we define certain projects that are currently scheduled in fiscal year 2022, which is next year's budget. But if there's extra funding and we have that project ready to go and ready to hit the street, we can go ahead and move forward with that project. So we want those in the queue in case I get one of those continued projects gets delayed and I have a project ready, I can move it up. We have projects both on the wastewater side and the stormwater side. There's a total of $220 million worth of work identified on the contingency list of 35 projects. If you look at the big number there on that slide, phased funding, there's 13 projects for $175 million. Those are projects, large projects, some of the tunnel projects, some of the treatment plant projects where we're funding that project over multiple years. What we'll do is we'll put the next year's funding on the contingency list. We hope if projects are moving forward and for some reason the cash flow requires it, we'll move that funding up into the current fiscal year in order to keep the construction on that project going. So we try to plan out the cash flow on those large phase projects over multiple fiscal years. So we put some dollars in the contingency in case that project's going faster. I think we probably had 2 of those type projects this year where the construction was going well enough that we moved those projects forward. Are there any questions on the contingency projects? Next slide is 23. This is a breakdown of the new project types. This is a total list of the 171 projects and then the kind of projects they are. In that detailed presentation, separate presentation I provide you, really breaks down each one of these individual categories. It discusses the categories: asset management renewal, city shed, CSO, SSO, treatment plants, district-wide, and stormwater. It goes into each one of those individual categories of projects and describes what the purpose of that program is, what the results of the projects will be. So that really gives you a good picture of it. As you can see, right in the middle, our sanitary sewer overflow, or SSO program, has the majority of the projects. There's 64 of those projects, totaling about $236 million, which is basically 2/3 of our overall budget. It's about 62%. So the majority of our projects, again, are part of the SSO program. The second largest is the top line there, asset management renewal. There are 19 projects, about $41 million worth of projects. Several of these projects are asset renewal projects that we have going at the plant. There's a large project at our Bissell wastewater treatment plant on our bar screens, a significant project that has to be completed ahead of our largest project for our new incinerators at our Bissell treatment plant. So that makes up a good portion of that $41 million. Again, the detailed presentation will give you specifics about the projects within each one of those areas. This concludes my presentation. As Brian indicated, I can answer questions on the CRP portion. I'm available if you're looking through that detailed or looking through the budget book. Just feel free to shoot me an email or give me a call. I'll be able to answer your questions. If I can't answer it, I'll get you an answer. So at this time, I'll take questions, and if once I get those answered, we'll turn it back over to Marion. Marion, back over to you.
Okay, I'm going to move on to slide 26 and kind of talk to you about the upcoming budget schedule. So before I do that, though, just a quick overview of the information that the board should have received by now. So earlier in March, I distributed at the March board meeting, and also we had delivered to board members that were not able to attend that meeting copies of our FY21 preliminary budget document, and there was a separate document which is called our capital budget supplement that contains information on our capital program. So you should have those two documents. In addition, of course, we have distributed today's presentation that contains information on the budget as well. There was a separate detailed document that Rich referenced, which provides information or more detailed information on our capital program. So there's 4 different items that the board should have by now. If for any reason you need a copy of any of those documents, please let me know and we'll get that to you. So moving forward, we are going to put ads in the newspaper regarding an upcoming public hearing that will be necessary, and I'll talk about that in a moment. We will, during the Finance Committee meeting, tentatively scheduled for May the 5th, provide you with any additional changes to the budget document, and I do anticipate that there will be some changes, so we will discuss those with you and also answer any questions that you may have. In the interim, please contact me if there are questions that you have prior to that meeting. We plan to introduce our budget at the May 14th Board of Trustees meeting. In addition, there's a public hearing that is required that relates to our proposed taxes. That will take place after the Board of Trustees meeting. And then finally, in June, we will ask the board for approval to adopt the FY21 budget. So are there any additional questions that we can answer? If not, that concludes the presentation.
Thank you, Marion.
Okay, hearing none, Trustee Singer, I will turn it back over to you.
Okay, let's see where we are here. We're all the way down to agenda item number 9. Is that right?
Yes, sir, that's correct.
Next meeting is tentatively scheduled for May 5, and I would entertain a motion to adjourn.
So move.
Okay, the meeting is hereby adjourned.
So everybody,
Is this the last one?
Everybody on the line, we have one more meeting that'll be a closed session, so if you hang on, we'll just get organized here. We'll be ready to go in just a minute.
Is there any,
We're still on, okay. Yeah. We're ready, Trustee Yates, to start.
Welcome to the Stakeholders Relation Committee meeting. We already have the roll call of the members here, but no comments by the chair. Can I get approval of committee meeting minutes on February the 4th? So moved. Can I get a second? All vote by the usual sign. Aye.
aye?
Ayes have it. All right, we're going to go into closed session to
Michael,
discuss legal
Michael,
confidential.
Michael, let me
Okay.
get ready. Yeah, so for everybody who's online, the board is ready to go who's listening remotely, the board's ready to go into closed session. We're going to shut down the broadcast or any communications until that closed session's over. The only remaining portion that's left during public, that it would be in the public, is the board coming out of closed session and then adjourning the meeting. We will continue the broadcast after that point. Feel free to stay, but you won't be able to hear anything during closed session.
All right, we will need to make a motion and take a roll call vote to go into closed session. So there's a motion to go into closed session to discuss legal, confidential, or privileged matters under 610-021-1. Ms. Fair?
Yes.
Mr. Wilson?
Yes.
Mr. Singer?
Yes.
Mr. Fall?
Yes.
Mr. Yates?
Yes.
All right, we are in closed session. Thank you.
We can get everything.
All right, could I get a motion to go from closed session to open session?
So move.
Can I get a second?
So moved.
All vote by the, all vote by the
Aye.
usual sign, aye.
Aye.
Ayes have it. Can I get a motion to go for a meeting adjournment?
So moved.
Can I get a second? All vote by the usual sign. Thank you very much.
Aye.
Thank you,
Okay,
trustees.
everybody.
All right, take care, everyone.
Thank you. Stay safe.
Yeah.